Hey guys, welcome back. It's another episode, another premium course, another lecture. But before you skip, this lecture is a very important one, very important. So I noticed most of you just don't watch the videos to the end, complaining it's too long. So I'm going to try to make this video brief as I can, right? So intraday A.M.D. You might be asking, what is it with the A.M.D? I just like talking about A.M.D. Well, there's a very big issue with the A.M.D. It holds lots of information in the chart, right? But we've talked about weekly A.M.D, we've talked about power of three, we've talked about daily A.M.D, but we've not talked about this intraday A.M.D, and this is just as important as the other A.M.Ds are, right? So you want to know these things. Most times you see these things on my chart, but I don't explain them because I've not made a video for it. Now I'm making a video for it. So from today, after you've watched this video, you're going to get full understanding of why I do these things, right? Let's go straight into the lecture. Okay, so we have talked about this A.M.D many times, so you must have fully understand what it means, right? I don't need to start explaining A.M.D again from the beginning. The accumulation, manipulation, and distribution, we've talked about it many times, so it's kind of your thing now, right? So the intraday A.M.D is quite different from the rest, and of course comes in very handy. Intraday A.M.D is not like the weekly A.M.D, is not like the daily A.M.D. This one is different, but it comes in very handy and it's very important. When talking about A.M.D, it has something to do with the previous week or previous day. That is for the weekly A.M.D and the daily A.M.D. But intraday A.M.D is different, very much different. And before we continue further, please, I want to make this known that I did not learn this from anywhere. No video, no course. This is my personal study, my personal research, my personal teaching. So in case you're seeing this particular lecture after this video anywhere else, you know that it came directly from this video. There are many people that plagiarize content without giving credit to the main source. I've seen it many times. I've seen it on Twitter, I've seen it on Telegrams. I don't really like it, but I don't talk about it, right? But I'm just making this known that if you see this anywhere else, you know that it came from this particular channel. Okay, so let's continue. Intraday A.M.D has nothing to do with the previous day. You might be asking, that's tricky. But other A.M.D, like the weekly A.M.D, has something to do with the previous week. The daily A.M.D has something to do with the previous day. But why does intraday A.M.D has nothing to do with the previous day? But we're going to talk about that. We're going to see some examples and some diagram, right? So as the name implies, it only occurs within a day. Intraday, this particular type of A.M.D only happens within a particular day. It has nothing to do with the previous day or the previous week or previous month or anything. It just happens within that previous day, and it's very good for intraday trading. You will not understand this thing by just watching this video just once. You need to go on it again and again and again, and you need to do some exam practice, some research, some studies on your charts. I'm saying these things because yes, it took me a while before I could finally understand these things, even though I came up with it, even though I started studying it, but picking trades with it was very quite difficult. I needed some more time, some practice. That's why I'm telling you this, right? Bearish intraday A.M.D. So this is not a structure. Most people like this structure of a thing. I don't like doing structure. I do diagram. This is a diagram, an illustration for you to understand how the intraday A.M.D works. Okay, so let's say this is the opening of the current day, this particular vertical line. Sorry about that. This is the opening. Okay, this is the opening of the first day, and this is the closing of that same day. But what happens within that day? Why is price like this? Most times you see price like this, but you don't understand. That's why I'm bringing this picture right in front of your nose. So we have this first displacement, and this displacement have fair value gap on the higher time frame, right? There's a fair value gap on the higher time frame on this first displacement. What does price do during New York session? During New York session, price retraces back to that higher time frame FVG, and that is the intraday A.M.D. This is the accumulation or whatever I want to call it, the manipulation, then distribution before price starts going. Sorry, this is the distribution. This is normally the manipulation. This is kind of a tweak. It's different from the way the normal AMD is, right? So this is the manipulation. Sorry, this is the manipulation. This first displacement. The sorry, this is the accumulation. What am I saying? This first displacement is the accumulation. Price accumulate. All the displacement is an accumulation. Yes, it might sound different, but yes, this is how it is. And price manipulates straight into that fair value gap, then distributes. This is the last movement of that day. You might see this thing. This thing just happened recently at the time of this recording, which is May 24th. This particular thing just happened recently, but none of you noticed. None of you understood it. That's why I'm bringing this lecture right in front of you. But you might be asking, why is this displacement accumulation? Well, we'll go into that. We'll talk about that. Let's look at the bullish intraday A.M.D. So the first accumulation happens with a displacement leaving fair value gap. And from, in case you want to skip this video now, or you want to forward, or you want to exit, this thing happens on a specific time frame, and I'm going to mention that at the end of this video. I'm not going to say that now. This particular thing, this fair value gap, we want to be looking at a specific time frame, not just any time frame, right? So we have this accumulation, manipulation into that fair value gap before distribution, the last move. So if you were supposed to pick these trades here, you see that price has nothing to do with the previous day. Let's say the previous day price action is below here, and this is the opening for the new day. This is the closing for the new day. This is the opening. This is the current day price action, right? Price has nothing to do here. It just started with this accumulation, start going, leaving this fair value gap. Then as price is retracing, some of you do this a lot. I've seen it on the Telegram channel, where you guys will be looking for price to mitigate some drawn liquidity or some fair value gap on the lower time on the previous day. It does not happen. Instead, it just straight into this and keep going. And at that day, you miss entries. And those kind of days, I'll be here looking for trades, picking my entries here. That's just how it is. I'm not saying I'm the best. Trust me, I'm not saying I'm the best. I know this technical analysis too much. I've just given you much time to study these things, and I'm giving it to you for free. What kind of generosity? Well, the intraday A.M.D does not happen every day, so you should know that. But it is a good strategy for continuation trades. You can see it's very very much a continuation trade. You see price is going higher, and you want to pick the continuation to go higher, and price just retraces, pick you and go higher. Not limit order. You need your confirmation. Very very good confirmation. And there's another thing I've noticed. I like noticing things. I like observing things, so I talk about them here, so you don't make those mistakes again. I've noticed that most of you like using that's the simple entry model, yeah, the OT. You like using the 1 minute time frame for your simple entry model. Please stop doing that. Don't do it anymore. If you've been doing that, don't do it anymore, please. The 1 minute time frame is very complex, and it takes time, maybe months, maybe years, for you to be perfect with it, right? So stop using the 1 minute time frame for your simple entry model. That might be your biggest mistakes why you have a poor execution method. Use the 5 minute time frame for your entry model. Then you can go to the 1 minute time frame to get sniper, but you want to get that simple entry model with the 5 minute time frame. You want to see that simple entry model on the 5 minute time frame before you can be sure of picking any trades. Please take this correction. For those of you that have been doing it, don't do it anymore. Stop looking for simple entry model on the 1 minute time frame. As time goes on, you adapt to the 1 minute time frame. It's too complex and too complicated. Use the 5 minute time frame for your simple entry model, right? Okay, so it's good for picking continuation trades, and mostly happens on large range days and in the distribution phase. So you might be asking, when does this one-sided thing happen? It does not happen every week, but most times it happens. There's a month that there are 4 weeks in a month, and all of those 4 weeks there was a large range day, and a large range day it either came twice a week or once a week. So that's how it comes, twice a week or once a week. But when it comes that day should not be a no trade day for you. You should know exactly what to do that day. That's why I'm bringing this lecture for you. It's very important, and it's my signature. It's how I pick continuation trades. I've not taught this anywhere. This is the first time I'm releasing this, and in case you see it anywhere, this is the main source. So this happens only when the previous day is totally efficient and has no draw liquidity, or the previous day holds MIMB, manipulation imbalance, for the week. I've talked about this before. I say, the daily A.M.D, the previous day need to have a drawn liquidity. A previously drawn liquidity. That's a PDH or PDL. That's previous day high or previous day low, or a previous day fair value gap, right? So if the previous day have all of this draw liquidity, price will surely be attracted to those levels. But in a case where the previous day is totally efficient, like you go to the 1 hour time frame, there's no fair value gap there, there's no low. You go to the 15-minute time frame, there's no fair value gap, there's no low for price to trade into. Then that is only when you get these large range days. And when you get these large range days, how do you treat them? Exactly just like this, the intraday A.M.D. That's where it comes in. Because price has no reason to go back to the previous day. Why? Because there's no draw liquidity, there's no low, there's no high, there's no fair value gap. The price just does the exact same thing I'm talking here. I'm talking about it, the intraday A.M.D. Let that sink into your head. Not only does price happen on a day that has the previous day drawn liquidity, it happens on a day that holds the MIMB for the week. I've talked about this before, and I'll still teach about this. I've not talked about this yet, but I've talked about it before. You currently don't know what the meaning of MIMB or how it happens or how it shows or the manipulation imbalance for the week, what it even means. But I'm going to talk about it. The manipulation imbalance is an imbalance that stays on field till the end of that week. It mostly happens during Tuesday or Wednesday, sometimes even Thursday. Tuesday, Wednesday, and Thursday you might have. Sometimes it happens on Monday, but it's not constant, right? The manipulation imbalance happens when it happens, right, for that week. After it happens, that's when the intraday A.M.D. comes in. Price have no reason. It's an imbalance, yes. For you, you'll be expecting price to trade into it because it's an imbalance that happens on the previous day, and it's a previously drawn liquidity, but to me it's not a previously drawn liquidity. I want to see that imbalance on field. Let's remain like that till the end of that week. Probably it might be filled the next week, but for that week it should remain like that. This is pure narrative, not structure. And I'm going to teach you exactly how to spot those kind of imbalances. Stick to this channel and subscribe if you haven't. So to use this effectively, the 1 hour time frame and 15-minute time frame is mostly recommended. This is the part where I promise that I'm going to show you, I'm going to tell you exactly the time frame you need to use for this. To get the intraday A.M.D, that's to get the perfect FVG where price is going to react to, use the 15-minute time frame or the 1 hour time frame. Start from the 1 hour time frame. This is why I don't like people using their phones to trade. You see the way my system is, I have different tabs. I think I've shown it before. I don't know which episode, but I've shown it before. I have different tabs where I open different time frame on just NASDAQ. The first tab is the 1 minute time frame. The second tab is the 5-minute time frame. The third tab is the 15-minute time frame. The fourth is the 1 hour time frame, and the fifth is the daily time frame. And those are the time frames I mostly use. Those are the only time frame I use. I don't use 4 hour time frame. You might use it, but I don't use it. I don't use monthly time frame. You might use it, but I don't use it. I don't use 30-minute time frame. You might use it, but I don't use it. This is how my strategy works, and this is the time frame my strategy manifesting. Right. So if you are going to look for these things on the 30-minute time frame, you might have a different reading entirely. You want to use the 1 hour time frame first. When a day opens and a day is already trading during the London session, right? You want to see is there any okay, you want to check first the previous day. The previous day, does it have any drawn liquidity? It doesn't. Okay, fine. And you want to look for intraday A.M.D. So you wait during the London session, let the London session print, or then wait during the New York session. New York session is when price does that retracement. That's a fake move. You want to mitigate into somewhere, right? So you look for the 1 hour time frame, you see that fair value gap there, you draw it. You are not commanding price to come into that fair value gap. This is the mistake most of you do. There are sometimes where a day might have different drawn liquidities. I've suffered this before. It has happened to me before. I've missed many trades because of this, and I'm trying to tell you early so you don't make the same mistakes I used to make then, right? There's many times where a day, let's say we have different PDL, two different PDL, and a new day opens, and you have two previous day drawn liquidity. That's the previous day low. We have two previous day low on the previous day, and this is where the confusion begins. Because to me, I'll be like, okay, I want price to target this particular low. It's like I'm commanding the price to come to where I want it to be, but that's not how it works. That's not exactly how it works. You just want to wait for price to react to any of those drawn liquidity. Anyone price reacts to, you get to your simple entry mode on the 5-minute time frame. No, that's not 1 minute time. If you get on the 1 minute time frame, you might likely be induced, because the 1 minute time frame holds a lot of complications. You want to wait for the confirmation on the 5-minute time frame. So if price reacts to the first draw on liquidity and give you that simple entry model on the 5 minute time frame, then that is where price is going to react to. Price will ignore the second previous day draw on liquidity. You just want price to do its thing and you react. That's just it. You're not predicting. So you might have a previously drawn liquidity. You have a previously drawn liquidity, like let's say previously FVG. Since you don't know how to spot the manipulation imbalance, so you have a previous day FVG and you are waiting for price to react to that previous day FVG. Don't be too fixated on that FVG. This is what you should do. If price should ignore that FVG and give you the intraday A.M.D, then use the intraday A.M.D. Don't fear for price coming back for that previous FVG, because price has clearly shown you that it's not going back there. It's not interested in that FVG. So you need to adapt. Market condition changes during the day. So you need to adapt with it. The fastest way you can adapt it is the faster you can adapt with it is the faster you can get into trades, right? I don't know if you understand this explanation I just made, but you can listen to the video again or listen to this particular area again so you understand it perfectly. If you have a PDL and you're expecting price to go for that PDL, but price totally ignores it, then does that intraday A.M.D, the first accumulation where it's displaced with higher time frame FVG, that's the 1 hour time frame FVG or the 15-minute time frame FVG, then it happens during London, right? Then the New York session price drops into that higher time frame FVG. On the 5-minute time frame, you get confirmation. That is your trade. You should not be waiting for the PDL again. That is your trade exactly. Price will go and leave you, and at the end of the day, you end up not trading anything. This has happened to me many times, and I'm trying to make you not fall into that particular way, right? So let's look at chart examples on this intraday A.M.D. These things happens almost every week, so you can go to your chart. Don't take my word for it. Go and study these things, right? Okay, so this was just May. This was just May 23rd. Today, at the time of this recording is May 24th. So this was just yesterday. And I'm using the example. There are thousands of examples I will use. This thing happen every week. You just need to go to your chart and look for these things and study how you could pick trades with it, how the confirmation was printed. Write these things in your journal, and that's how you learn. That's just how you learn. Don't take my word for it. So we have price on the previous day where price headed for a buy side liquidity. And as price headed for a buy side liquidity during the Asian session of the previous day, you know what to be expecting now. Let's say some people will be expecting this as a previous day high, but if you've watched the protected and unprotected highs and lows, then you know that that high is protected. Until price takes out a sell side liquidity below here, that high is protected. This is how you mix all the puzzles together. This is how you put all the puzzles together. I'm teaching these things episode by episode, well arranged. So when you go into your charts, you just use all these things. You've written them down on your journal. You can remember them. Use all these things together. This high is very much protected because it's taking out a buy side liquidity. If you don't understand why I mean why I say it's protected, go back to the protected highs and lows lecture and watch that video. So since that high is protected, we don't have a previously drawn liquidity for price to trade into. This is the current day, and what does price do? During London session, price displaced. Sorry, okay, this is the particular example I'm talking about. So during London session, this is the 1 hour time frame, so you don't get confused. This is the 1 hour time frame, not 15 minutes, not 5 minutes, not 1 minute. This is 1 hour time frame. This is the opening of that day, and this is the closing of this day, of the current day. On this example. So price leave this displacement here. Now, if you check, there are other imbalances here. On this, okay, this was 12 a.m., 1 a.m., 2 a.m. New York time zone, 2 a.m. That's London session, right? There was a 1 hour fair value gap there, and there's still 1 hour fair value gap here. Now, in this case, what do? Do you draw and wait for price to trade into this 1 hour fair value gap, like you're predicting price to reach for that? No. You mark this out, you mark that out. You look for where price will react to, then that's your trade. You wait for price to react to here, and this was all the consolidations that happened during that London and that New York session. All the consolidations, I was just perfectly waiting for a 5-minute simple entry model. And at that point, I saw many people buying. Many people was buying. This was, I think, this is Wednesday, May 24th, and this happened on May 23rd. So if you are on the Telegram channel and you clearly know what I'm talking about. If you're not on the Telegram channel, join with the link on the description. right? So I saw many people during London session, what they were just buying. Why? Why are you buying? It's because you lack higher time frame analysis. You are not doing any higher time frame analysis. You are just dwelling on the 5 minute time frame and on the 1 minute time frame. I used to do that, and it killed me. It killed my account. Don't do that. You need to get a higher time frame narrative so you know what you're doing. Many people bought and they got some profit and price started consolidating and boom, took all of them out. I was it was hilarious because I already dropped the chart and I already dropped exactly where I wanted them to look at, but they went doing the opposite. So price trades into this 1 hour value gap. You get your confirmation, and that's the accumulation, distribution, sorry, accumulation, manipulation into that fair value gap and the distribution. This was more than 100 pips. All of these trades was more than 100 pips, and that was how I took my trade yesterday. The entry, the execution is going to take a lot of time to practice, but this is how you do these things. Trust me. Let's look at another example. Don't take my word for it. Go to your chart on the May 23rd. Just calibrate your chart like this. Outline everything like this, and go to the lower time frame and look for how possibly you could pick that trade. That's how you learn. So this is another example of May 18. I'm calling this date so you can go back to your chart after this video and look at these days and look for other days that this thing happens, because I am not going to give thousands of all these examples, but it happens many times. I'm just giving this particular example so you know exactly what I'm talking about. I don't know if I talk too much. It's kind of my thing. I talk fast enough. It's kind of my thing. I don't know. I cannot talk slowly, and if I talk slowly, the videos will be boring. It'll be boring for you. So that's why I just try to talk fast. I'm kind of a fast talker. So, anyways, this is the opening of this day, May 18, and this is the closing of that day. If you go to your chart and look on the previous day, there's imbalance. Yes, there's imbalance, but that imbalance was the MIMB of that week. It's supposed to stay on field for that week. So what happened exactly? Well, most people, after they lost trade yesterday, that was May 23rd, I heard some people was like, I don't trade PM. I already took a loss in the AM, so I don't want to trade PM. All of those things, it's just a matter of time. You change all of those things. Trust me. I used to make those kind of rules. I've changed my rules thousands of times. I'll write my rules today. The next month, I'll change it, remove some things, add some things. The other month, the coming month, I'll change it, remove some things, add some things. There are sometimes I'll say, I don't, when I trade in the AM, I don't trade in the PM again. But I'm not the chart. If the chart give me exactly what I want to see, then I'll trade. That's just it. So all those things you guys are saying on the community, it's just a matter of time. You don't want to trade in the PM, you will trade. It's just a matter of time, right? Don't worry, I've been there. So this is exactly a one-side day. A one-side day, that the large range day. This is just exactly how it is. Now, why is it a one-side day when there is a previous day FVG? Most people were looking for the previous day FVG, but price did not react to that. That was the MIMB. And if you want to know exactly how I look for this MIMB, how exactly I see this MIMB, stick to this channel. I'm giving out premium lectures here. I upon everything I'm teaching here, some people still come to my DM and be recommending course for me if they can actually buy these courses and all of that. Most times that's why I actually off my read receipt on all my social media platforms, and just a matter of time I'm going to off my DMs. You will not be able to contact me again. I'll delete my WhatsApp because the messages I get most times are just too frustrating and too annoying. I'm giving you a lecture here. This is your mentor's course for free. The course you are going to buy $100, $200, $300, $50. This is it here for free, and you still have that mindset, that time, that audacity to come and be recommending courses for me to tell you if it's safe for you to buy. I don't understand how the way human beings are. But anyways, that aside, you can see these examples of what I'm talking about. We have the London session 12 a.m. here, 1 a.m., 2 a.m., 3 a.m. London session. That 3 a.m. is the heart of London session. What happened? Price left a fair value gap. 1 hour time frame. On 15-minute time frame, that fair value gap is still visible. But I like checking for my intra-day A.M.D. on my 1 hour time frame first. If I look at my 1 hour time frame and the 1 hour time frame is efficient, then I'll go to my 15-minute time frame. There'll surely be an imbalance there for price to retrace to, right? So exactly New York session, price did what? Dropped. Dropped into that fair value gap. You look for entry there. There will be an entry model there. 5 minutes, 15 minutes, there will surely be an entry there. You pick that as your entry, you long. Why? Some will be like, there's a fair value gap there, and there's a fair value gap below on the previous day, and you'll be scared to enter these things. Yes, it's normal. You'll be scared, of course, to enter this particular trade because of the fair value gap below. Like I said, don't trade on a new day. Don't buy above a fair value gap. Yes, but when it comes to the MIMB, it needs to stay filled. It needs to stay on field. So price did that, dropped into that fair value gap. You can see there, perfect. Dropped into that fair value gap, then trade higher. After trading higher, leaves this fair value gap there on the heart of New York session, AM session. This was exactly, I think, 10 a.m., 10 a.m., 11 a.m. Then PM, after the lunch time. These times I'm mentioning should not be new to you if you've been following this channel lecture from episode 1, right? Exactly PM, price retraced into that fair value gap and continue upward again. You can see this is just pure narrative, not structure. Not pure narrative. You go into your chart and look for this. This is why I don't like people dwelling on the lower time frames too much. You are using your phone, you're only looking at the 5-minute time frame, 1-minute time frame till the whole of the day. You're not looking at the higher time frame picture. If you understand this fair value gap, you don't want to pick limit order. That's why most times people say, why don't you use limit order? I don't use limit order because I'm always on my chart. If price drops into that fair value gap and gives you that 5-minute OT, if it gives you 1-minute OT, like you see this large wick here, you see this large wick here that shoots up here, that will be a perfect OTE on the 1-minute time frame. Then what happened? Price still came down below, taking out that candle low. I don't know if you understand what I'm trying to say. But if you're looking on the 5-minute time frame, I'm not going to go to the 5-minute time frame. You just need to go. This is May 18. Go and study the entry modules on that particular place, that particular level. Outline these things like this and study them. Price retrace into the fair value gap, intra-day A.M.D. The accumulation, the manipulation, and the distribution for the New York AM session, and the PM session did exactly the same thing. Just like that. And you wait for the next day. This is a previous day fair value gap. The next day will drop into that and continue. Just like that. No complications. Now let's look at the last example. This day was exactly May 10. So you can go to your chart and study how this works, or what happened here. I'm calling out this date for that reason. I'm not saying you should take my word for it or anything. Just go to your chart and study exactly how these things work, right? So price did what? Price dropped. Where is it dropping to? Was there any imbalance there? I think not. Accumulated, manipulated, and distributed. When you be thinking this drop. That's what some people will be thinking. This particular drop. Does it mean that this fair value gap is now our intraday A.M.D? Well, no. Even if you take this fair value gap as an intraday A.M.D with no experience, you can take this fair value gap as an intraday A.M.D because it happens on the heart of London session. Then during New York session, which is 9 o'clock, you'll be waiting for price to trade into this A.M.D. That's why you should not set the limit order. You'll be looking for price to trade into this fair value gap and continue downwards, just like as I've explained here. But no, you always want to wait for that 5-minute confirmation. You always want to wait for that simple entry module. If you are set limit order here, you'll be taken out because you don't wait for confirmation. That's exactly how it is. But price give this displacement again, and during PM, price retraced into that fair value gap. Give it that 5-minute entry. This is one hour time frame, so there will surely be 5-minute entry, simple entry module there, and you pick your trade, and boom, to the end of the day, you make about 100 pips or so. That's how it reads. That's how the intraday works. On this previous day, there was no drawn liquidity there. If the chart was that wide enough, I'm not giving you all of the information here because I'm telling you to go to your chart. I'm forcing you to go to your chart. May 10, 1 hour time frame. Look at the previous day. Was there any previously drawn liquidity? Was there any previous withdrawn liquidity? If possible, there was a previous week fair value gap that price dropped into, and a previous week SSL internal liquidity that made this the end of the manipulation phase. Sorry about that. That made this the end of the manipulation phase. So price taking out that SSL, the previous week SSL, the previous week SSL liquidity, that was the end of the manipulation phase, and price just continued going upwards. That's the distribution phase started from here. I'm not giving you all of this information because I want you to go back to your chart and look at those things, right? So this strategy is very best for continuation trades. Very, very best. You can see how you pick continuation trades. You'll be scared that, oh, price have gone, price have leave me, but you don't know exactly what price is doing because you are on the 5-minute time frame, on the 15-minute time frame, on the 1-minute time frame, always looking at any break of structure to pick your entry from, or any other block. I'm not bashing strategy here. I'm not saying my strategy is the best. It is what it is, right? Just go, don't take my word for it, study it if it's helpful. Okay, but now I've made note of these things. I'm going to be calling them out on the Telegram community because I saw it like not proper to be calling this particular module here on the Telegram community when you understand nothing about it. You'll be like, what is he doing exactly? Why is he not looking at the previous day draw liquidity? But it taught us to be looking at the previous day low. It taught us to be looking at the previous day AVG and all of that. So if I tell you that you should be looking at this particular 1 hour time frame, this candle time frame, and ignore the previous day draw liquidity, you'll be confused, right? You'll be totally confused. That's why I'm bringing this lecture to you. So now you understand this lecture. If I call a particular candle, 1 hour candle, for you to mark as your intraday A.M.D, and the still previous day low below, you know exactly what I'm talking about. That's any one price react to. If price reacts to the intraday A.M.D, then that day should be your entry. I don't want you to be missing trades again. I want you to pass your profs. Recently, a guy that's one of the YouTube students here is learning from this YouTube student. He passed the phase 1 on his profile, and I'm happy for it. It's not something that takes 2 months, 1 month. It takes time. It takes months. It takes years. You surely get there, right? You surely get there. Trust me, I want the best for you. That's all. I want the best for you. I'm not extorting you for anything. I just want the best for you. So this strategy is very best for continuation trades, and this needs much study before implementation, because I know most of you, the moment you just watch this video finish, the moment you are exiting this video, if you see that same module, this same module I just talked about happening today, you jump into it. I know there are people like that, people that don't want to miss opportunity to jump into it, and they'll come telling me, oh, this is what I learned, it works. So you don't lose trades, you don't have issues with execution or entries. Go and study these things out first. Go and study them. Do all the homeworks I've given you, all the days I mentioned. Go and look at these things, and trust me, don't stop at only May 10. Go back. It happens. Just calibrate your chart, backtest, study. That's your assignment for this week. And exactly Sunday on our next weekly market analysis, I'm going to ask for these things, right? So if you see this video insightful, if you actually learn something new from this video, make sure you journal them down and subscribe, right? I shouldn't be begging you to be doing this thing. I'm helping you. I don't know how many lives I'm touching with this. There are many people who cannot afford a class, who cannot afford a course because it costs way too much. $100, $50, $150, and in times like this, economy is too hard. Some people are still struggling, and I'm giving you a way out. This is a wormhole. A way out. Study these things. Give it your time. The only thing you need to spend here is your time. You don't need any other course. Just focus on this course. It works. I'm not telling you things that only print one day on a chart, or something that just happens one time in a year. You bear me witness. I call trades day after days, week after weeks on the Telegram channel. And if you're not witnessing that, you can join. So you witness that. I'm not telling you, and it's exactly the same thing I teach. I'm not telling you things that doesn't work or things from textbooks, right? So if you see this video insightful, I shouldn't be begging you to subscribe, and I shouldn't be telling you to share this video. It's not fair. You're learning something for free. It's only fair you do that, like, in return. In return, all I'm asking is for you to share the video. Share the video to your community, to your WhatsApp status, or any community you're in, if you've actually learned something from this channel. And also subscribe, okay? Thank you very much, and I'll keep dropping premium lectures like this. And until next time, be safe.